Well, hello, everybody, and welcome to this COVID-friendly Zoom-recorded Market Outlook and Strategy webinar titled After the Rebound. My name is Jeff Porter. I'm Chief Investment Officer here at SBSB. And as always, I'm joined by my friends and colleagues, Gary Lyons and Walt Knockett.
Hello, everyone.
Hello, everybody.
So here's the agenda for today's discussion. We're going to start off by giving you our thought process around some profit taking that we did in stocks in August and September, especially for those clients who had gotten a little too far away from their targets. Then we're going to talk about my old baseball coach and how he had a saying, "You think you stink," and what that has to do with investing in today's market. And then we'll wrap up by talking about the hot topic of the day, of course, the election, its potential impact on markets, and thus decision making. But before we do that, let's take a quick look back at where we've been. So what you're seeing here is post-World War II bear markets, and in red is this year's experience. And you'll quickly notice that this was the quickest decline in history, followed by the quickest rebound in history. And I think most people get the decline, right? We've had a global pandemic, the economy essentially ground to a halt, and the stock market reacted. But the questions that we've been receiving most often, and the questions that we continue to receive, are essentially, why has the market rebounded so quickly in the midst of such economic, really, destruction? And while we'll freely admit that this is the worst economic downturn since the global depression, and that the trauma will be with us for years, if not decades ahead, it's not necessarily abnormal for the stock market to do well when the economy is stuck in the mud. And you can kind of see that with this data here. Looks at data going back to 1960, and it compares how the stock market has done in different economic growth environments. So let's take a look at that top row there. When the economy has been really humming, growth is over 6.1%. That actually has made stocks not react too well, down negative 4.6% annually. When the economy is growing kind of in the middle there between 0.8 and 6.1, the market's done pretty well, 7.1% growth. But it's done its best at 12.1% annualized growth when the economy is not growing nearly at all or is negative for year-over-year growth, below 0.8%. So there's a number of reasons why this is. One is that it gives companies, especially those large public companies, cover to slash their workforce and slash expenses and become really lean. And that eventually drops to their bottom line, and investors like that. Also, as we've mentioned in the past, the market runs ahead of the economy. So prior to the worst of the economic outcome, stocks have already declined substantially. They've already become cheap, and bargain hunters rush in the midst of even the darkest hours for the economy. And lastly, leadership comes to action. Pretty much in every economic downturn, you've had a healthy dose of both fiscal and monetary policy injected into the economy. And there's really nothing more that the stock market likes than liquidity. Isn't that right, Walt?
Yeah, Jeff, absolutely. Global central banks have been providing investors with a lot of liquidity, not only here in the past 6 months, but it really goes all the way back to the great financial crisis. And so what the chart that we're looking at here is the S&P 500 in red and the total assets sitting on the central bank balance sheets of the Federal Reserve, European Central Bank, and the Bank of Japan. And there's a interesting dynamic and relationship here where the blue line and the red line are increasing, going up and to the right together. And what that signals is that there's a high correlation between the two. Meaning if the Federal Reserve, the European Central Bank, and the Bank of Japan are buying bonds and providing liquidity, what has been known to as quantitative easing or QE, that tends to bode well for stocks. And you can see that in this relationship here. So it's the old adage, don't fight the Fed. And it really comes down to don't fight global central banks. This started with QE back in 08, 09. And really what you can see here, if we focus in on QE4, that green bar going down the middle there, you can see the parabolic spike in blue. And what we can say is that investors, if they're making a gratitude list during this pandemic, being grateful for Jay Powell and the other central bank leaders that have been able to come to the market and provide the market with great liquidity has been massive.
So we've had this great rebound, right? But in August and September, as I mentioned, we took some profits for a lot of clients who had gotten too far away from their targets. So why is that? So in recent commentary, especially this year, we've talked about the importance of understanding the market expectations and sentiment. So essentially, when market participants are extremely pessimistic, that tends to be very good for stocks going forward as they set themselves up to be pleasantly surprised. And vice versa. When market participants are very optimistic, that tends to mean bad things for stocks going forward because they set themselves up for disappointment. So the next question is how do we measure that sentiment? And this is, one of our favorite charts here, or indicators. We've spoken about it in the past. We've showed it to you in the past. It's the Ned Davis Crowd Sentiment Poll. And we like it because it is a collection of a number of different sentiment indicators, and it puts it in one index. And you can see that index reading there in orange. So when the orange line is low, that means the market is very pessimistic. When it's high, then it means that the market is extremely optimistic. And you go to the right there, you can see at the bottom of the market in March, the index reading for sentiment was at a low reading at 37. But then in late August, it had moved all the way up to above 66. So why is that important? So take a look at the upper right-hand corner table, because that shows you the connection. That shows you how stocks have done based off of various sentiment readings. So let's take a look at the bottom row first. So when sentiment reading, in this case, has been below 57, that actually has been good for the stock market, up 11.10% annually. And this is one of the reasons why we felt comfortable buying stocks in March and buying stocks in April because of this. Now, it's actually best for the market when the sentiment is still low but rising. So you can see when you're in the range of 57 to 66, returns have been an amazing 22.28% annual gain. Obviously fantastic. Now just take a look at the very top row here. When sentiment is above 66, extremely optimistic, that actually has not meant good things for the market going forward, with a negative 3.19% annualized return. And again, this is one of the many reasons why we wanted to take some profits and pare back on some stock exposure in August and September. So hopefully that gives you a little insight on what's going on behind the curtain, so to speak. But whenever we're talking about sentiment, you're really talking about the short-term movements of the market. So now let's kind of take a step back, broaden our lens to think about the big picture. And when I was thinking about this section, I had to chuckle because I thought about my old high school baseball coach who had a saying, "You think, you stink." So during the week of practices, we'd often work on the fundamentals. We'd work on the technique. So for example, batting, we'd talk and think about how we were loading our body, how are we transferring our weight, the swing plane, etc. But when games came around and he saw us kind of too far in our heads, thinking about too many little things, he would say this. He'd say, "Guys, remember, you think, you stink." And he'd also say, "Just see the ball and hit the ball." So essentially he was saying, now just focus on the big picture. The work has been done on the little things. Don't focus too much into the weeds. And I think that's probably pretty good advice for investors right now and likely going forward, because there's certainly a number of risks out there that are tugging at our emotions, and they're kind of pushing you and pushing us all into making big moves with our portfolios. but it's important to concentrate on the big picture as mentioned. And Gary, that big picture starts always with where are you on the business cycle and also what the Federal Reserve is doing.
Absolutely, Jeff. And everyone who's been with us for a while has seen this 4-quadrant chart before. Each box is showing where we are in terms of recession or expansion. And is the Federal Reserve tightening or easing? And the number in the box is the average annual return under that particular scenario, based on S&P 500 data from 1954 forward. So on the lower left quadrant, in the first quarter of this year, we had been in a recession and the Fed was not easing at first. And notice, by the way, that this combination historically causes a 34% drawdown on the S&P 500, which is exactly what we had. Of course, the Fed's intervention quickly transitioned us into that upper left quadrant, still in a recession, but with the Fed easing. But now, hopefully, we're in the upper right quadrant. The Fed is still easing aggressively, but we may be in a more pronounced expansion. Either way, we're headed toward the expansion with the Fed easing combination, which has the best potential for forward returns. You see it there, 11% annualized since 1954. In other words, the most return potential for the least risk.
So Gary, these are kind of two of the three biggies. So you got the where you are in the business cycle, what's going on with the Federal Reserve. And the other big one is valuations. And we've gotten a lot of questions about valuations. So let's talk to that.
Absolutely, Jeff. So on this chart, the blue line is the trailing 12-month S&P 500 price to earnings ratios going back to 1926. And the yellow arrows there are earnings spiking just before they dive, typically in a recession. And by the way, on all these charts, as always, those gray bars are recessions. And as you can clearly see here, currently, valuations are expensive, but not as expensive as they seem. The current price to earnings ratio reading is approximately 26, and I'm looking all the way to the right where the blue line is intersecting the red line. Not cheap, but certainly not like the early 2000s when we were at 46, as you see there on the chart, or early 2009 when we were at 122 price to earnings ratio.
So clearly, having a high PE ratio, more so than most of history, isn't necessarily a good thing. But as Gary pointed out, you have these spikes in recessions as prices kind of move ahead of the economy, move ahead of earnings. But you also notice that as you move on early into the expansion, when you get through that recession, you see spikes down in price earnings ratio pretty much every time. And that's, again, as the E in PE catches up, earnings go up, and it pulls down that ratio. So yes, it's certainly high relative to history, but it's not as high as probably most people are expressing out there. And it's also important that when you're evaluating valuations, when it comes to stocks, to understand what's going on in the interest rate environment and what bonds are offering. So Gary, please speak to that.
Yeah, absolutely, Jeff. So in fact, when we look at this chart, it's showing the ratio of the S&P 500 dividend yield over the 10-year Treasury yield, 1935 to present. And stocks have not been this attractive versus bonds since the 1940s. In fact, the current dividend yield of the S&P 500 is nearly triple that of the 10-year Treasury yield. And this condition has historically been followed by stocks outperforming bonds over the next 12 to 18 months. Now, we're not talking about double-digit returns, But despite the relative attractiveness of stocks over bonds, this highly anticipated great rotation of investors moving from bonds into stocks has yet to fully occur according to the fund flows that we're monitoring. So still a relatively attractive opportunity in stocks versus bonds. Now, Walt, you call this opportunity TINA. Tell us about TINA.
Yeah, absolutely, Gary. There's a lot of acronyms being thrown around in the financial headlines these days. ZIRP for zero interest rate policy, which is now being conducted by the Federal Reserve. And as a result of that policy, a new acronym has come out called TINA, and it stands for There Is No Alternative. And really what that is referring to is there's a big pool of institutional money out there. Think pension funds, endowments, foundations that need to make 5% or so plus inflation. So a 7 to 8% type of return. And with interest rates in bonds down at 1 or 2% these days, mathematically, they just can't allocate a large portion of their portfolio to bonds. So they're forced out the risk spectrum. So meaning there is no alternative to try to achieve their target return. And historically, that's been a tailwind for stocks. And so to switch gears a bit and get back to what Jeff was referring to at the beginning, one of the major questions we've received over the past 6 months is what is driving the disconnect between Main Street and Wall Street, or the stock market and the economy. And it's really important to note that the stock market is not the economy, and the economy is not the stock market. The stock market is a leading indicator of the economy, really trying to forecast where the economy is headed over the next 6, 12, 18 months and years ahead. And so Bill Ackman, he's a famous hedge fund manager for the past few decades. He was recently quoted as saying, "The stock market represents the strength of the best and most dominant, best capitalized companies. And the stock market that doesn't exist is a market of private, family-owned mom and pop stores that is now being decimated across America." Meaning that the S&P 500, these companies are doing extremely well, and it's really coming on the backs of the regional mom and pop stores across America. And that's why you've been seeing some of those fiscal stimulus packages to try to help those people struggling. So what we show here on the chart is 4 specific examples of S&P 500 companies that have actually done extremely well during this pandemic. And so the first one is Home Depot. And we continue to see data come in that home improvement sales are just increasing by at an exponential rate. And Home Depot has built the technology where you can order online, go to the store, and have someone drop it off through your window in your car. Very convenient. Or you can have it shipped to your door. As opposed to before, you may go to your local hardware shop and talk to the salesman or saleswoman and talk about the project and what tools you may need and get any advice. So Domino's Pizza is another classic example of success over the past 6 months. They were recently in the headlines because they hired 20,000 workers. And Domino's Pizza is seen as almost a technology company these days with their app. You can order a pizza and wings from your phone while streaming Netflix and not have to talk to anyone. It's a perfect pandemic work from home type stock. FedEx is the best of the bunch here of these examples, very self-explanatory. If e-commerce has been driving the bulk of results, I know we have a package getting dropped off at our door each day, and we see the neighbors with a similar trend. And then Lennar Corp is an interesting one. They're a home builder. And this is an interesting theme where the housing recovery has just been tremendous. And you really are seeing people flock from the cities and living in high rises to getting a bit more space and moving out into the suburbs. And what you see there is you need to have new homes. So these home builders are doing really well. So when we look at some of these examples, it's helped to bring it back to the bigger picture in the broader market, and that the market may not be telling the whole story. So on the really, it's a more than meets the eye, what we would say. And what we show here on the right-hand side is a bunch of individual stocks, but we highlighted a few of the famous indices that we track. So the S&P 500 there in the middle, you can see is up about 5.5% through the end of September. But we also highlighted the Dow Jones, and you can see there down about 1%, bit heavier in terms of industrials there. The S&P 500 equal weight is a really good example, down about 5%. That's essentially taking what is the average stock in the S&P 500 doing. And then we also showed international stocks as measured by MSCI EFA. So that's Europe and primarily Europe and developed Asia, Japan, down about 7%. And then the Russell 2000, as we talked about earlier, the smaller cap companies in the US have been hit a bit harder than those larger cap companies, down about 9%. So when you look under the radar and just get away from the high-flying NASDAQ or the S&P 500, the returns start to make a little bit more sense given the economic carnage that we've seen. Another thing that's making sense is some of these individual stocks on the bottom. You know, I'd like to point out the cruise lines, the airlines, Exxon, Marriott, travel and leisure. Those stocks have really been hit hard as expected, and their stock prices reflect it, down between -40 and -70%. And then on the flip side of that, if we look at that top stock, Boston Beer, similar to a Domino's in terms of a pandemic hanging out at home stock, we've definitely seen beer and alcohol sales grow during this time as well. But a big theme that we've talked about a lot is just the dominance of these tech stocks. And that's what's really keeping the S&P 500 afloat. And the S&P 500 is the top 5 stocks are tech stocks: Apple, Amazon, Microsoft, Alphabet, and Facebook. And recently, they make up about 25% of the entire index, a concentration that we haven't really seen since the late 2000s. And what this chart is showing is actually what the top 5 tech stocks now equal the bottom 389 stocks in the S&P 500. And so these aren't small companies. These are big companies: Clorox, T. Rowe Price, Twitter, Chipotle. You can name, again, all of these. These are not your smaller cap companies. These are big companies. And the one fact that really stands out is Apple alone is equal to those bottom 200. And with over a $2 trillion market cap valuation, the growth in these names has been incredible. And really, we've been able to take advantage. Our clients, investors have been able to really participate, and it's been great, but it certainly does carry a lot of risks, right, Jeff?
Yeah, I mean, absolutely. You know, in our industry, sometimes the S&P 500 is called one of the biggest and greatest momentum funds out there, because if a stock is doing better, just because it's doing better, it gets a bigger position, a bigger weighting in the S&P 500. And if it continues to do well, then it pulls the index up. So before this recession, you know, we had these tech companies doing well. They were a bigger portion of the index. And it just so happens that this recession was caused by a pandemic that is kind of right in the technology wheelhouse. And thus these big names continue to do well, and that drags up the quote market. Now this is great on the way up. It does add a little bit more risk if this were ever to turn, if these big 5 or technology were ever to come under fire, antitrust, higher regulations, higher taxes, or if smaller technology companies started to disrupt the disruptors, then that's going to be very difficult for all these companies on the left-hand side of this chart to make up for the weakness of the big 5. And that's why it's prudent to, you know, not have all your eggs in one basket or one theme, and to diversify outside the S&P 500 as well. All right, so now let's head into our last section of the discussion here, and that's, of course, the election. As I mentioned, we're getting a lot of questions about the election. A lot of people are worried. They're worried about a contested election. Many are worried that Trump will get reelected. Many are worried that Biden will get elected and there'll be a Democratic sweep. And while politics and elections are certainly extremely important for many areas of life, it's pretty crystal clear that it doesn't move the needle too much with respect to markets. And you can see that here, which compares the relationship of markets to elections and politics. So generally, you got to the left here, Democratic president and Congress being split up in various ways. And to the right, what has happened when there's been a Republican president and Congress split up a number of different ways. And now take a look at the y-axis there to the left, which shows the R squared. So the R squared is a statistical tool that shows the power of the relationship, the correlation between two things. So an R squared of 1 would mean that, in this case, elections and politics are perfectly connected with stocks. And thus, if you had a bet, if you knew exactly what was going to happen in an election, then you know exactly what was going to happen in the stock market. Now, an R squared of 0 means that there's pretty much no relationship. And that's what you see here. You see 0.00, you see 0.01, you have 1.02. So again, this is data going back to 1956, and it's clear that it just doesn't move the needle that much. There are other bigger forces, more important forces at play. So whenever you're talking about politics, and we're going to continue this discussion, it's just important to put it in context. And with this caveat, Gary, let's still talk about it. Let's talk about what the potential outcomes may be and what it means for the market. But again, let's keep it in context.
Absolutely, Jeff. So this is Cornerstone's forecasts of how markets might respond to the election. And first, as we've mentioned many times, it's very important to remember that markets are a forward discounting mechanism. And of course, that means that any positives or concerns or negatives are being priced in now with certain adjustments later. So starting with the overall market, if the Democrats sweep, it's negative. Higher taxes, greater regulations, probably a labor agenda, and then big sectors can be at risk. Drug pricing, Jeff already mentioned, tech and antitrust law. Also tougher regulations on finance and energy. But look down at the miscellaneous category. The negatives are to some degree offset by huge infrastructure bills and lower tariffs. And what about if a Biden win occurs, but the GOP Senate stays in place? That's marginally positive. You have lower tariffs there, lower uncertainty, no tax hikes, but greater regulation costs. And there we think at least an infrastructure bill is possible. But under a status quo outcome, we're looking at neutral. Favorable tax and regulatory environment would be preserved, but tariff risk and overall uncertainty is actually higher. Again, in the miscellaneous category, the positives there, infrastructure bill possible with greater defense spending upside. And one last category, not on the chart, but always positive for either party, is monetary policy, which in any scenario is always very powerful and offsets a lot of negatives. So there are always lots of offsets. And as we will see on this next chart, even if you knew what would happen in the election, this chart shows a few of the so many issues with timing elections, both the current expectations and other factors. And again, remember, markets pre-price all widely known facts and opinions. For example, Republicans are generally viewed as more friendly, anti-regulatory, and free market oriented, whereas the Democrats are viewed as more big government oriented, more pro-regulation, which investors generally assume would undermine profitability and markets. But again, markets are discounting mechanisms. So all the reactions to the actual events are often the exact opposite of what you would think. For example, as you see there on the chart, which is using all past election data, the Democratic inaugural years are much better for stocks, with an average annual return of 16.2% versus the Republican inaugural years average return of 2.6%. Now look at the data for the actual election year. Fear over a Democrat winning dampens election year returns. Historically, an average S&P 500 election year return of 7.4%. But the pre-pricing of a Republican win heightens hopes of higher future returns, thus pulling those returns forward for an average gain of 15.2% in the election year. And you know, the reasons for this are very straightforward. Democratic presidents aren't able to implement most of their anti-business campaign promises, so the surprise is actually positive, reversing the prior year's fears. And in similar fashion, the Republicans are also unable to deliver on most of their pro-business campaign promises. And so the surprise is negative, again, reversing the election year hopes. So neither party can do as much as most investors fear or hope. And in fact, total market performance of those 2 years together is very similar when looking back over all elections. In fact, the spread is not statistically significant enough to suggest one political party is better or worse for markets over those 2 years. It's just really the sequence of returns. So Walt, it's never as bad as it seems or as good as it seems, is it?
Yeah, absolutely, Gary. And it really comes down to the question is what factors drive the markets? And as Jeff explained earlier with the R squared, which explains what factors actually drive it, we can see the political outcomes don't really sway the decision much. Now, of course, the markets care about it, and every 4 years it gets heightened. And investors tend to focus on it, especially as we get in a few weeks away from the election. But what really matters for the markets is corporate earnings, economic growth, fiscal and monetary policy, all of the things that we tend to talk about for longer term strategic views. And a perfect example of this was on the morning of September 30th, which was the morning after the first presidential debate. And the market was pricing in a higher likelihood of a Democratic presidency and a potential blue wave, given Biden's showing in the debate. And so the market opened down lower, given all the factors, Gary, that you just discussed about the high level. They are anti-business from a very high level. And so the futures were down. We get to about mid-morning, and then all of a sudden a news story breaks where Treasury Secretary Mnuchin and House Speaker Pelosi were back to the bargaining table for a fiscal policy CARES Package 4.0. And all of a sudden the market rallied into the afternoon and actually closed positive for the day, forgetting about the slightly higher odds of a Biden presidency and a potentially democratically controlled Congress. And what this just goes to show you is that other factors and millions of factors drive the market. And Gary, as you correctly pointed out, the market is amazing. It's a constant discounting machine of being able to feed all of these probabilities and expectations into current prices. So with that, it brings us to my favorite chart, which shows here, again, another case against trying to make big investment decisions or time the market around elections. And the chart that we're looking at here shows an investor that stays fully invested in the S&P 500 since 1957. And then an investor in the red that tries to time the market based off of a new presidency and misses the first 100 days after inauguration. And the big takeaway here is that investors are nearly 2 times better off by remaining fully invested instead of timing the market. And this always brings me to one of my favorite investors of all time. Many share that sentiment, but Warren Buffett, who always says, don't mix your politics with your investment decisions. And back in 2016, he was cited as saying he's been a net investor of equities through 8 Democratic administrations and 8 Republican administrations. And it's treated him very well. And really, it also brings up the old adage, it's not about timing the markets, but time in the markets that matter. And we always try to maintain that long-term strategic view when we're building out investment strategies and constructing portfolios.
Well said, Walt. Thank you, Walt. Thank you, Gary. Let's finish up with a few takeaways for the listeners. And, it starts with expectations. We've been talking a lot about that. We think it's really important to think about expectations of the markets. So if you're thinking, I think the market is going to go up or down based off of X, Y, Z, your next thought should be, okay, what is the market pricing in? What does the market expect? And is it different than that view? So in August and September, we saw that sentiment was too optimistic. And that was one of the reasons why we decided to take gains. And we think this type of rebalancing, the rebalancing we did in March and April, as well as August and September, is likely to be more important moving ahead, especially if volatility continues as we kind of continue on through this coronavirus, as well as hopefully this expansion. So the second point there is that, yes, there are numerous risks ahead. There are going to continue to be risks ahead, but it's important to not lose sight of the big picture. We feel that we're at the beginning of the business cycle. We feel that there's monetary and fiscal policy that's going to be at our back for quite some time. And historically, that has meant good things for risk assets such as stocks. Number 3 there is a negative. Valuations, they are high, especially in the United States. This is definitely going to keep a lid on stock market returns, so to speak. But when you look underneath the hood, you look at the individual stocks that Walt was showing, you compare it to the historically low bond yields that Gary was talking about, and it doesn't look as bad as you would think. And lastly, as we just mentioned, elections, politics, they're important for so many different ways, in so many different ways, for society and the world. But history is pretty clear that it tends to be a fool's errand to make decisions, investment decisions around the elections and politics, because there are other major drivers in stocks that are much more important. So that's all we have for you today. Thank you for listening.
Yeah, and thank you also very much for joining us today. We so very much appreciate our clients, and we're always happy to talk with you. Call me, call Jeff, call Walt, call your service team if you need to discuss anything, or if you want to comment or just have a question. We always enjoy hearing from you.
Thanks.